Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz. Let's get across those market moves overnight. And on Wall Street, surging with the Dow hitting a fresh all-time high. And similarly with the S&P 500 also at a record, up around more than 1.5% in fact. And the Nasdaq up more than 2.5%. Led by those tech stocks. In fact, Mag 7 stocks somewhat mixed though, following yesterday's gains. Meta and Amazon actually declined despite a broader market rally. Microsoft posted a gain, along with Alphabet and Tesla. Stocks specifically though, Palantir shares, they surged 29% as you can see there after second quarter earnings smashed expectations with adjusted EPS of 41 cents versus 35-cent estimate, and the company lifting its full year revenue guidance well above prior forecasts. And SpaceX, its first quarterly results as a public company, beat expectations, but concern about those AI costs, which actually hit the stock in after hours trade, taking a bit of a tumble despite those gains prior to the result. And obviously that's going to take us to what we're watching on the local market to tech-wise, given the flow through from those AI names. On the macro front, the prospect of an interim agreement on the reopening of the Strait of Hormuz has gained traction. Qatar says a proposal had been drafted and both American and Iranian officials are hopeful they can reach an agreement to reopen the critical waterway. US Treasury Secretary Scott Bessent saying we're in talks with the Iranians and I think there is a chance we may have a deal today or tomorrow to open the strait. Well, on the data front, US ISM manufacturing PMI for July came in at 55.6. That's above the 54 forecast and the highest reading since May 2022. Production and employment both strengthening. And we'll also take a look at ISM services PMIs today. Non-farm payrolls following on Friday. That'll be critical for the market. The latest bout of investor optimism has seen bond yields fall. The US 10-year at around 4.61%. And checking in on currencies, the Aussie is up around 0.75% to 70.5 US cents. Oil prices have fallen to a 3-week low after comments by the Qatari and US officials raising hopes of a diplomatic resolution to the Iran war, which could improve oil flows through the Strait of Hormuz. Brent crude falling around 6% to below $79 a barrel. Gold was supported by falling oil prices that tempered inflation fears and lowered bets for high US interest rates. Spot gold up at close to $4,080 an ounce. Copper futures rose 1.5%. Iron ore little changed at $95 a tonne. And Bitcoin as currently trading just above 64,000 US dollars. Well, returning to Wall Street, the VIX may be sending a calm signal, but beneath the surface, what is going on? To tell us, we're joined by Anu Ganti, Head of Index Investment Strategy at S&P Dow Jones Indices. Anu, welcome back to you. That was a very impressive session just gone on Wall Street. But when we take a look at volatility there, what's that telling you, particularly then when you compare that with that stock level dispersion?
Excellent question. It's great to be here, Andrew. And we just had a remarkable comeback in the market, which was great to see. And you're absolutely right that volatility, especially implied volatility, looking at the VIX, has been relatively low. But I will say there's a lot cooking underneath the surface. And you pointed out dispersion, which is a measure of cross-sectional volatility, which measures the spread between the winners and the losers. And we typically see that that number tends to be higher during earnings seasons. And that's exactly what we're seeing right now. In July, you're looking at it right now, we reached extreme levels for not just the S&P 500, but for the S&P 400, as well as the S&P 600, particularly high levels within the emerging market space. So it's been very interesting to see this high level of dispersion, that higher company level risk. And particularly, you talk about semiconductors and tech. That's been a big driver of it. The other driver is just the rotation that we've seen away from tech and towards defensive stocks, the rising market breadth that we've seen overall this year. So dispersion is definitely something to be watching right now.
So overall then, Anu, given what you're seeing there, what does that tell you about broader investor sentiment, just how vulnerable I guess it is to market shocks. Now that may not be a broader sort of market shock there, but it can be stock specific, and in particular, I guess, when you see such huge moves in individual stocks.
Absolutely. It tells us a couple of things. We've talked about stock pickers and our SPIVA scorecards earlier, where we measure our active manager performance. And dispersion is a measure of that skill, of that opportunity set. And the greater the stock specific dispersion is, the greater the opportunity for managers with the skill to outperform. So that's one of the reasons that we're closely watching dispersion right now. The other point that I'll add is we've talked a lot about realized dispersion, but the other measure to watch is implied dispersion, or the market's expectation of future dispersion. We have an index called DSPX, which measures that. That actually hit an all-time high in late July, which tells us that the market is continuing to price in that higher dispersion. And I think one of the reasons for that, of course, is the greater scrutiny on big tech. You talked about it earlier with the hyperscalers and the increased focus and scrutiny on CapEx spending. So it appears that higher dispersion, at least for the short term, is here to stay.
So you talk about the scrutiny of big tech there. We've seen those outsized gains, and to be fair too, we've seen some sharp falls as well. So, and given the dominance there of those AI-related stocks, that leads to that concern about concentration risk. How is that playing out in equity markets at the moment?
Of course, concentration is top of mind right now. One of the indices to look at right now is our S&P 500 equal weight index, same 500 companies as the S&P 500, but equally weighted. It has actually outperformed the S&P 500 for 2 consecutive months. So this will be interesting to watch to see if that continues. Of course, today and yesterday, we saw the recovery with the mega caps and the hyperscalers and the return of momentum. So the question is whether this return of equal weight is going to be a short-term or a more pervasive trend. So certainly concentration is top of mind right now. The other trend to look at is, of course, at the sector level. We have equally weighted sector indices. So interesting to watch the dynamic there. The other sector that we're looking at closely, in addition to tech, of course, all eyes are on tech and semiconductors, is energy. For example, energy has been moving very differently to the rest of the market, given that tailwind of rising oil prices. So coming back to dispersion, there's stock-specific dispersion. You can also measure it at the sector level, at the country level. So lots of idiosyncratic company-level risk happening right now.
And you point out the correlations across markets is relatively low at the moment. What does that mean then, particularly for the investor trying to construct a portfolio, as you think about diversification?
Yes, and correlations are important to measure, because we talk about overall index volatility, which has been low. A big reason for that are these low correlations. In fact, correlations in the S&P 500 reached more than a 10-year low. So this is a positive thing to see those broad diversification effects at the index level. But I will say that the correlations that I'm referring to are the stock level correlations. It's also important to look at correlations across asset classes. So for example, if we look at the correlations between equities versus bonds, that has been positive for a while right now, which may be a headwind when thinking about asset allocation. The other correlation to look at right now is, of course, within commodities versus the S&P 500. For example, as mentioned earlier, we're seeing that energy has behaved differently versus the rest of the market. That could be potentially good from a diversification perspective. So there's lots of different ways to slice and dice diversification at the stock level, at the asset class level, and at the sector level.
Anu, what are your observations about what you're seeing here on the Australian market in terms of, well, dispersion and also those correlations you talk of?
Yes, it's a good point. We track the S&P ASX 200 on our dispersion dashboard. And what we're seeing, in fact, is that volatility and correlations have been relatively low by historical standards. Dispersion has been relatively moderate right now within the ASX 200. So it's not at the extremely high levels that we're seeing in the US, for example, with the S&P 500, the S&P 400, and the S&P 600. So moderate levels right now within Australia. But I will say that if you look at the overall emerging markets complex, particularly in China, we saw extreme levels. In fact, we hit a record high of post 2007 record of 74% in our S&P China BMI index. So a lot of actioning happening within the emerging market space.
I know, always terrific to get across what you're seeing in markets with that analysis. Thanks so much for joining us from S&P Dow Jones Indices. Let's turn our attention to the local market then. Ahead of the open, we are expecting a strong start, up almost 0.5%. That is off the back of that very strong lead-in we got from Wall Street. And of course, focus today on more results as reporting season slowly gets underway. We'll unpack that and more. Join us for the open.